Good afternoon, traders. This video is all about my trading plan for February. I found some problems with my plan last month, and also a lot of it was things that I was doing that were not really a part of my plan, but I've added stuff to this month's plan to just make it that much harder for me to make poor choices. So that's what this plan is all about. It's a very strict plan. It's very simple. It's very easy to follow. And if I break it, I basically have to stop trading for the rest of the month of February. So that should be a good motivation for me to just strictly trade what is in the plan. So I'm still doing the all or nothing 2-hour trading, which means that whatever risk I take on each trade, my profit target is 2 times that risk. That basically allows you to have even less than a 50% win rate and still be green at the end of the month. So that's the beauty of the 2-hour trading. Of course, it's a probability of working out is dependent upon your entry, so you have to have very strong entries and understand how trading pattern or sorry candlestick patterns form and which stocks to pick and all of that. So there's a lot to it. But if you're doing all those things right, which I'm pretty good at this point, then your chances of succeeding with this 2-hour trading is very high. So I'm kind of resetting the account. It's a little bit below this right now, but I'm just putting a small deposit to bump it back up to 525 just to keep it away from the $500 mark. That's a psychological thing. If I'm right around $500, I just feel a little bit uneasy because if the account falls below that, it's much more noticeable that, oh my gosh, now I'm in the $400 area. I was in the $500 area. So, it's the psychology of day trading. So this is just a little buffer for me. And then this is something new that I added. Stay away from all stock market news and YouTube channels except for live traders. So what that's all about is really what's been happening recently. All this craziness with the Wall Street bets, which I don't follow, but of course I noticed all the stuff going on with GME and AMC. And I didn't trade GME for that exact reason because I didn't want to get involved, in that hype. And it seems like, in the long run, that's probably paying off because I know right now there's a lot of restrictions being put on traders. That, if you're in a position on GME, you might not be able to get out of it right now, which is pretty crazy, but that's outside of the scope of this video. But anyway, I just want to kind of avoid all of the madness that goes on in the stock market and the hype that gets pumped up in the news, whether it be social media or CNBC or whatever. I already know exactly what I want to trade and how I want to trade it, so I don't need to be swayed by any type of a news outlet or social media or even other day traders' YouTube channels. So the only one that I'm allowing myself to watch is live traders, and that's because that is basically the model that I've developed as far as my day trading plan goes and my strategy. That model comes from the way that Jared Wesley and Anmal Singh teach trading on the live traders channel. So I'm allowing myself to watch that channel because all they do is talk about trading the way that I like to trade. So I'm not going to be swayed to trading any other way or taking high risk trades and all that kind of stuff. So my number one goal for this month is no yellow trades. Again, if you've seen my other videos, you know what a yellow trade is. That's when I take a trade that's outside of my plan or outside of my strategy. If I take a yellow trade this month, I'm going to force myself to stop trading for the rest of the month of February. So that is kind of a built-in motivator to keep me trading to my plan 100%. So yeah, this is where I kind of define it. This is more for you guys. A yellow trade is breaking any of the following rules. So here's my rules. These may not work for you, but I know this is what works for me. Only enter a trade during pre-market from 4 to 4:30 a.m. I am most profitable at this time. I have over 3 months of data now proving that that's the time where I make the most money. I'm always green in the pre-market at the end of every month, and I'm not always green during the intraday, and aftermarket I'm usually break even, sometimes green. So I just decided, you know what? This is where, I do the best. So that's the only time I should trade. The other benefit of that is that the rest of my day is free to do other things. I'm not a full-time day trader. I have a job. My job's on the weekends, but I also do a lot of things during the week that require a lot of time and energy. So if I can get my day trading done early in the morning like that, then it's just that much better for me. Plus, that's when I'm profitable. Only trade stocks in the top 3 volume of the top gainer screener. That's an old rule, and that's a good rule. And yeah, I may miss out on some other movers that are below the top 3, but in the end, I think I'm going to avoid taking trades and stocks that I shouldn't be taking by looking for stuff below that top three. So that's what that's all about. Float size of around 100 million shares or less. So that's kind of like in the low to medium float range. And I've just noticed that around that number seems to be where the most chance for quick growth in the stock is. So that's where that number comes from. Maximum of 3 trades each day. This is kind of a new rule. I've been doing 6 trades per day lately, but the problem with that is, well, I was spreading them out. I was doing 2 or 3 trades in the pre-market, and then a couple of trades in the intraday, and then maybe a trade or 2 in the aftermarket. But since I'm only trading in the pre-market now, I'm going to limit myself to 3 trades each day, and that's basically to protect the account. So the only outcomes are either going to be I'm going to have a winning trade, a 2-hour winning trade within those 3 trades, and I'm going to stop trading at that point. That's what this says. Or after the 3 trades, all 3 trades have failed, and at that point I would stop out anyway. So that kind of follows the 3 strikes you're out rule. Each trade will be a 10% position size. So that means that whatever my buying power is, each trade I'm going to take a 10% position size on. That's a little bit new. I've been doing 8%, but of course that was because I was trading up to 6 times a day. So I wanted there to always be funds available. Right now, I'm only going to be doing 3 trades a day. So the maximum amount that I'll be trading with of my account each day is 30%. So that's actually lower than when I was doing 8%, 6 trades a day. I could be trading up to 48%. So that should help. I'm putting less of my money at risk each day, and it'll give me a little bit of a buffer at the end of each day. I'm also saying never add to a trade no matter what. So this is kind of like a variation on the don't average down, which I don't ever average down. Averaging down means that you're putting more money into a losing trade, and that's just not a good idea, even though it works out once in a while. But this is just to remind me because I took a trade the other day where I didn't average down, but I averaged into a trade that hadn't hit my stop loss yet. And then it did hit my stop loss after I added to it. So, that just goes to show you that, once you're in a trade, just stick with your original position size because you don't know. It could go in your favor. It could go against you. And this way, no matter what, you're limiting your losses. The only patterns that I can trade are the ABCD pattern and 3 and 4 bar plays. So that's kind of like the 3 and 4 bar play is kind of like a consolidation play. So that's what those two are. Both must be after the price is broken through the previous high. So if I'm trading at that pre-market 4 to 4:30 a.m., then I'll mark out the high from the aftermarket, which also must be higher than the previous day. Otherwise, I won't trade it. That's not really in here, but that's just kind of an unwritten rule of mine. So basically, I'm looking at the most recent high, and then at 4 a.m., the price needs to break through at some point, and then when it pulls back, that's when I can get in for one of these patterns. So the way I'm defining my ABCD pattern is that the point C must be above point A. So if you watch my live trading videos, you'll know exactly what that means. But basically, let's say that point A is at $10 and the stock goes up to $11. That's point B, and then it pulls back. It can't pull back any lower than that $10 point. Otherwise, I can't take a trade. So because what ends up happening at that point is it becomes a reversal trade, which I don't do because they just don't work out often enough. Now here it says don't think about red or green, just profit at 2R or stopping out at 1R. Those are the only 2 possible outcomes of a trade. And that idea is just to keep me from scaling out. I used to sometimes get afraid that a trade wasn't really going in my favor and it was too choppy for me or whatever. And then as soon as I was like getting a little bit of profit, I would start scaling out. And then more often than not, the thing would end up going to 2R. And at that point, I've left a ton of money on the table. And if I take another trade after that stops me out at 1R, now all my profits are wiped out. But if I would have taken that 2R profit, then I would have been able to withstand at least 2 more losing trades. So that's the idea behind that. And then 1R includes your actual stop and actual entry. Again, I used to kind of play around with, well, I'll just use kind of the limits of this candle, the low and the high of the candle. But again, that ends up leaving money on the table and costing you money in the long run. So whatever my entry is and the 1 cent below the previous candle, that's going to be my stop. If there's no lower floats in the top 3 volume, don't trade. So if I don't see anything around that 100 million share size or less, or low float size, then I don't trade. That's it. Avoid stocks that are trading right around $1. That's a little bit of a kind of a weird thing, but basically, when these stocks kind of run up from the less than $1 range up to $1, they end up being very, very choppy right around that dollar mark. So that's kind of why I'm doing that. Plus, they're hard to trade because if it's below $1, even 99 cents, you have to buy 100 shares. But as soon as it hits $1, you can buy as little shares as you want. So there's a lot of issues with trading stocks right around $1. So I'm going to be looking for things slightly above $1 or more. If there's no volume between 4 and 4:30. So this is an old rule. I need to, I kept this on here just in case, the next month I start trading intraday again or whatever. I don't want to forget what happened on this day. And even for now, this is a good thing to remember while I'm trading in the pre-market to watch out for very low volume days. There was one day, the Monday of Christmas week, where even by 4:30 a.m., the number one stock was only trading with 6,000 shares. So that's just a reminder, even if there's stocks in the top 3 volume, if there's only a few thousand shares being traded on those stocks, they're not worth taking a trade on. Only take the ABCD setup, buying the first pullback after a new high, or 3 and 4 bar plays after a new high. So that's kind of, I talked about that earlier. Stop is always the low of the previous candle. It's actually 1 cent below, but it's based on the low of the previous candle. This is a new thing. Don't analyze the price action while you're waiting for the price to come back and break through. This is a psychological thing. There was one day where I, was basically trading this plan. This plan didn't exist, but I mean, the same idea, that the stock must break out through the previous high before I can take an entry. But while it was below that previous high, I was watching the price action and I was just commenting like, oh, this could be a good reversal play here for those that take a reversal. I ended up talking myself into taking a reversal trade at that point, and it went against me and I lost money. And it's a place where I shouldn't have lost money because I don't take reversal trades. So that's what that's about. Always know your stop and target before entering trade. That's just a reminder. That's crucial. You don't even understand the risk you're taking if you don't know your stop and your target. And the main reason behind that is because what if you enter and then all of a sudden the stock whips up or down? If you don't know where your stop or your target is, you can't exit out of the trade and you're going to take a much bigger hit than you should have. And this is, again, another helpful reminder. As soon as you enter a trade, get your 2R limit sell order out. Now, there's a little bit of a gray area there because if I enter the trade and it starts going against me right away, I don't want to put that limit order out because I'll have to cancel it before I get out. So that there's a little bit, of a detail to that one. But the idea is so that I can't scale out. So like if I get in the trade and it immediately starts going in my favor, I just want to get that limit sell order out for a couple of reasons. If it bounces up, I want to get filled and get out at that 2R, and I also don't want to be tempted to scale out. And then the last thing I'm going to go over in this video is my quick guide to setups, and really just the one for pre-market because that's all I'm trading. So again, ABCD and 3-bar plays. So here's basically the guidelines for taking a trade. The stock must be trading in the top 3 volume and in our price range. Looks good on the daily chart. Basically, that means that it's trading above the 200 MA line. So if you just pull up a daily chart and put a 200 MA line, you can follow that. Free float size, 100 million shares or less. Mark out the high of the day and watch for clean price action, including the high from the aftermarket. So that's because I can only take a trade once the price breaks through the high and then pulls back, because that's how I define a stock to be strong and worthy of a long position. Long meaning that I want the price to go up, not that I'm going to sit in the stock for a long time. If the price action is clean, wait until the price breaks through the high of day. That's basically what I just said, and pulls back. Let's see. Buy the first 1 minute candle to make a new high after the pullback, only if the high of day was not broken. Again, that's a little bit of a gray area. Really what I'm going to be following is that ABCD thing that I told you about, as long as the pullback doesn't go below the point A. Let's see. And then, and then this is just like a basic representation of what I am looking for. Let's say that 4 a.m. is right here. This is where the pre-market opens, and this was the price action in the aftermarket. It made a new high in the aftermarket right here. So then at the open, I'm looking for it to, or let's say it's right here at the 4 a.m. So I'm watching it and I'm not doing anything, even though it's going up here. I'm waiting for it to break through the previous high, which I mark out. Once it breaks through the previous high, then I look for a pullback, and then I enter when a 1 minute candle makes a new high. And that is known as the safest entry that you could possibly take. And in my experience, that's what I've seen as well. So that's what I'm doing. And again, it's not just about that entry, but it's all the other stuff combined, like, that you're trading a high volume stock, a lower float stock, all that kind of stuff. And that's pretty much it. That's my February trading plan. I just wanted to throw that out there because even if, I don't expect anyone to trade like me. Trading plans should be custom to your style, your psychology, your availability to, trade at certain times of the day. But this just gives you an idea of how you could develop your own trading plan. So I hope that helps you. Let me know if you have any questions and what you think about this trading plan. Take care. See you in the next video.